Exactly. Great. Thank you. Thank you for this opportunity and good morning and welcome. It's still morning. And thanks. I am really excited to do this presentation, and there's a couple of reasons. One is I'm very enthusiastic about the Efficient Group. As Villa mentioned, I head up the investment team at Efficient Private Clients. But the other reason that I'm so excited is because I've always wanted to use this quote: let's kick the tires and light the fires. I think that is a quote that comes from Independence Day when they're about to attack the alien spaceships. And I know you guys must be tired of all these aviation references, but that is just one of my favorites. So thank you for giving me the opportunity to use it. What our job is at Efficient Wealth is to keep our clients wealthy, to make sure that you save and that you preserve the amount of money that you saved for and worked hard for your entire career. And I just want to spend some time with regards to how we go about that. We run money a bit differently than most of our peers. We don't go and create a fund first and then allocate clients towards the fund. We rather build various building blocks and then through consultation with our clients find out exactly how they want to, one, structure their lives, and two, structure their finances. And then from there, make sure that we build your portfolio around that. So within the group, we have various investment houses. I'm going to start with Boutique Investment Partners. You can just see their logos there on the right. The reason we do it like this is we want the teams to be focused. Everybody has to be fantastic at what they do, and then we combine these building blocks at the end. It makes much more sense to manage money in that way than to first create the investment vehicle and then to look for clients that actually would fit in there. So within Boutique Investment Partners, there are in-house multi-manager. I went through some of the presentations, and I know you guys have met with a lot of other financial services providers, and I see that they also talk a lot about multi-managers and so on. What makes ours so good is that actually other financial advisory companies use our capabilities as well. So we don't just structure our in-house funds. We are actually so good at this that a lot of other companies make use of us as well to structure their multi-manager solutions. What a multi-manager is it's basically a team that picks the best funds for building blocks. So we create these building blocks, and within those building blocks, we need to select the best fund managers, and this team is really excellent in doing that. Then if we go one layer lower, we get to Efficient Private Clients. At Efficient Private Clients, we build direct investment solutions for our clients. We really focus on offshore. We see the world as one asset class. We, especially in the post-retirement environment, what we find is our clients are typically a little bit more affluent. They understand the world, so we have normally quite a big offshore component within our post-retirement funds. A lot of that is in direct equities. A lot of that is positioned around the world, and we can do that within a living annuity space and with after-tax money, etc. So I think that's quite important as we go one step lower, so we can select the best companies and we can select the best fund managers as well within the group, and we create those into various building blocks. And the reason that's important is then we sit with our financial advisors team and we build these custom solutions for our clients. I don't like the word custom that much or tailor-made that much, because it sometimes sounds like these solutions are built on the back of a matchbox or on the back of a napkin, and that's not the case. We spend a lot of time in customizing these solutions for our clients, and that is what we do at Naviga, where we really go and package all these in-house capabilities into a bespoke plan for our clients, because I think that is what we all want to do at the end of the day. There's two things that are very important, and there's no free lunches in investments. Well, there's maybe one, and that is diversification. In the investment environment, we can't just diversify between asset classes. We need to bring in other revenue sources as well. We need to diversify between investment styles, and we also need to diversify in terms of the actual way we access these investments. And I'm going to touch on how we do that. And then also at Efficient Private Clients, especially, we like our stocks like we like our socks. We like it when they're marked down. And that is the environment we're moving into right now because of COVID-19. So it's actually, out of a timing perspective, a very nice time to have these conversations. In terms of how we think about retirement money, as a blueprint, we follow a silo approach, and then we build those custom building blocks that I mentioned. What we typically do is we structure the funds into 3 various silos. And it really depends on your income need and your risk tolerance and so on, how these silos would look. But in essence, the idea is that we put your shorter term funds, so money that you're going to draw your income from, into a short term silo. That's typically 1 to 3 years income. It depends. We have these discussions with our clients, but the idea here is that we want to minimize risk in the portfolio. And in investment terms, as you guys know, there's basically 2 types of ways you can classify risk. The one is permanent loss of capital, and the other one is volatility. We don't want to take unnecessary volatility into our investment planning, and therefore we place money into low volatility structures where we can draw income from. The second silo, we increase the volatility and we increase the risk a little bit because the average return we can expect is a little bit higher, and we still don't increase it that much because we want to fill up the first silo, the shorter term silo. So we continuously de-risk the money that you have to draw your income from, while simultaneously make sure that you really get the optimal growth that you can. And that we really achieve through our longer term silo, which I'm going to spend some time on. So typically in the shorter term silo, the aim here is to outperform the average money market fund. We typically invest in income funds, and that is we target a return of approximately CPI +1. And as I mentioned, that's approximately 0 to 3 years worth of income. If we then go to the medium term silo, we really try and limit the volatility within the portfolio, but we up the risk a little bit. We normally put max 40% in equities. We use low equity funds, and here we target CPI +3, and it's typically between 3 and 5 years worth of funds. We then use this to fill up the first bucket when there's opportunity in markets. And then this is where we spend a lot of time, is in the longer term silo as well. And here we go maximum equities where we can, depending on market circumstances. We identify local and global equities. Typically, global equities have a very big proportion in these portfolios, and then also property has its role to play as well, although our property exposure at the moment is very limited. And also here we target CPI +6, and this is for your longer term funds. So this is really where we have to do the hard yards, and we have to bring in that longer term growth component. This is the component of the portfolio which we really have to keep you wealthy. We really want to preserve and grow your wealth. So how do we go about doing that? Well, we have various ways. One of the ways we prefer is to construct a portfolio of the world's leading companies. This doesn't mean it's the world's biggest companies. It doesn't mean it's the companies that are growing the fastest, but all of these companies really have a very specific role they play in the overall portfolio and in the overall wealth planning strategy. And we manage this on a daily basis. I'm not going to take you through an entire investment committee process, but I want to take you through what we focus on at the end. And there's basically 3 things that are important. If our job is to preserve and grow your long-term capital, what we do is we focus on companies with sustainable competitive advantages. These are companies like Nestle's of the world with 31 brands earning more than 1 billion Swiss francs in revenue per year. They can invest that behind their brands and make sure that they keep up with the latest consumer trends. We look for structural growth opportunities. I'm going to give you a few examples. Jeremy touched on some of them, but what is really important here is we don't want to bet against the way the world is changing. We are getting richer. It doesn't feel like that in South Africa at the moment, but the middle class in China is going to double in the next 15 years. We are getting older and we are urbanizing. And then also we spend a lot of time on identifying earnings progression. So what we mean by that is the world continuously changes, and there's companies that are very good at making sure that they change with it and to make sure that they can generate revenue going forward. And we spend a lot of time understanding those drivers as well. So how we think about investing long-term, what we actually found is that COVID-19 really accelerated most trends. There wasn't these massive sort of new trends that came to light, but a lot of it got changed or accelerated. Healthcare, for instance, we knew the world's population was aging. Most countries or most continents outside of Africa, actually, this was the case for quite some time. And there's companies that actually benefit from that, like your drug originators. And also, as we urbanize and as we age, we also have increase in lifestyle diseases. So our portfolios benefit from that as well. in terms of the technology space, there was a lot of sub-themes. Cloud computing was always a theme that we knew was going to do well. Investing in AI, investing in 5G, voice-activated internet, and also online security. Those were all sort of sub-themes, which, as we all started working from home, really became this from-home theme, where we work from home, we relax from home, and we play from home. And that's something that we expect to play through our portfolios as well. In terms of the financial space, I agree with Jeremy. We've thought that interest rates were going to come down for quite some time. That was the case. And that just got accelerated as economies wanted to create a lot of stimulus within their economies. So we actually position in terms of companies that benefit from increased savings rates like BlackRock, and companies like your credit rating agencies, which benefit from low interest rates. When interest rates fall, companies issue more debt, and that is good for a credit rating agency. And then in the consumer space as well, we focus on how the entertainment environment is changing, as well as the shopping environment through e-commerce. In industrial, I think it's important to just understand how companies and factory floors are changing, especially in terms of optimization and in terms of automation. And that's really coming to a fore right now. And in other sectors, we're avoiding property to a large extent. Utilities we're avoiding because of regulatory pressures, and the market is quite an interesting space. Willem, I'm out of time. I tried to rush. I say I have 1 minute left. Thank you so much for the opportunity. Have a fantastic day.